Today we'll show you a simple way to trade gold with Fibonacci. You will learn how to use Fibonacci retracement levels for the identification of strong reversal zones and safe entries. Take notes and get a step-by-step strategy and a profitable trading plan. We are in gold chart on a daily time frame, and the first thing that we will start our analysis with is the recognition of major impulse legs. For example, as you can see, we have a major bullish wave here. On our price chart, we can spot the lowest low and the highest high. And that entire bullish movement is a significant bullish impulse that will provide a base for Fibonacci analysis. Another important impulse leg that we can find is a bearish movement from that high to this low. As you can see here, we have a major bearish impulse. And between this major bullish and major bearish impulses, we have more impulses. For example, we can spot a very important high right here, and the bearish movement from that high to that low will be another important bearish impulse. Remember that when you do Fibonacci analysis, you will need to recognize at least 3 impulses, and very often you will spot even more. All these impulses will help you execute a very efficient Fibonacci analysis. After we identify significant impulse legs, we can start Fibonacci analysis. To do the Fibonacci analysis, we will use a classic Fibonacci tool, Fibonacci retracement levels. When we draw Fibonacci retracement of a bullish impulse, we strictly draw them from the low of the impulse to the high of the impulse. And here, as you can see, I have many different Fibonacci retracement levels. When you do Fibonacci analysis, always pay close attention to 236 level, 382 level, 5 level, 618 level, and 786. These levels are very important, and these levels work as the magnet for the market participants, and very often you will see significant price movements and major reversals after tests of this Fibonacci levels. Trade gold with a trusted and reputable broker. Get 100% first deposit bonus with the link in the description below. When you draw Fibonacci retracement levels of a bearish impulse, you strictly use Fibonacci retracement from the high of the impulse to the low of the impulse. As you can see, I easily do Fibonacci retracement drawing based on our major bearish impulse. And we have another strong bearish impulse that we spotted here. It goes, and based on that, we draw Fibonacci retracement levels. After we complete drawing Fibonacci retracement levels, we start looking for confluence zones. As you can see, our chart looks like a complete mess. In this mess, we should look for Fibonacci confluence zones, the zones where multiple Fibonacci retracement levels align. One of the examples of a Fibonacci confluence zone is right here. As you can see here, we have a perfect match of 2 different Fibonacci levels, and as you can see, that area was very important for the market participants in the recent past, and we saw significant bullish and bearish reactions to that area. Another important area that we can easily identify is right here. This area combines 3 different Fibonacci retracement levels. And here, remember a simple rule. The more Fibonacci retracement levels lie in one single area, the stronger liquidity zone they compose. On our price chart, this confluence area will be a very significant liquidity supply zone, the zone from where we will sell the market. We will expect a pullback from that area, and we will try to sell from that zone. And now we are ready to trade. Once gold price approaches that zone, you can sell the market from any level within that zone, and depending on your preferable reward to risk ratio, you can place a sell trade on any level within that area. Use the following rules for the trade execution. As you can see, gold price is currently testing the upper boundary of that supply zone. For us, it will be a very perfect point to sell the market from. So from that level, from the current prices, we can sell gold. To set a safe stop loss, selling the market from a significant confluence liquidity zone, identify the last minor impulse leg. In our example, we have a strong bullish impulse leg right here. Your stop loss will be based on a Fibonacci extension of that impulse. So I take Fibonacci extension, and based on this impulse, I draw Fibonacci extension, and our stop loss for the trade will be 1 to 72 extension of this bullish impulse. And to identify a take profit level for our trade, we will draw Fibonacci retracement based on this bullish impulse. We will draw Fibonacci retracement, and we will look for the closest confluence zone. In our case, we have a confluence zone right here, and that area will provide the target for our trade. Here is how our pullback trade for gold will look. That is a complete breakdown of this trading setup. We started with the identification of major impulse legs. Then we draw Fibonacci retracement levels based on this impulse legs. We found significant confluence zone, and we discussed that the zone provides a safe entry zone for our pullback short trade. We identified the last minor bullish impulse, and using Fibonacci extension, we found a safe stop loss for our trade. And using a Fibonacci retracement tool, we found the closest confluence zone that is the target for our trade. The best time frame to use this strategy is a daily time frame, but you can use the same rules for trading gold on any time frame. This Fibonacci strategy is tailored for pullback trading from a major liquidity zones. Follow the plan step by step, be disciplined, and good luck in trading gold. Trade gold with a trusted and reputable broker. You will find the link in the description below. Also, traders, let me know what do you want to learn in the next videos.